The yield on the 20-year Treasury is higher than the yield on the 30-year Treasury. This is signaling the yield curve is flattening and beginning to invert, which is flashing a giant warning sign signal that a recession is incoming. So in this video, we are going to talk about what the markets are doing in response to what interest rates are doing and what big money is doing to prepare. Ready? Let's dive in. So first off, the yield curve. The yield curve is simply a curve that plots the interest rates of debt depending on its maturity. In a normal environment, you'd expect that the longest term debt will have the highest interest rates because you've got the most risk the longer that goes out. So a 30-year bond is going to have more risk of default, more risk of inflation happening in between now and maturity than something like a 2-year. So what you expect to see is as that debt maturity increases, the interest rate increases as well. Now, what has been happening recently? The yield curve has been flattening. That means the interest rates on the shortest term debt has been increasing the most relative to the longest term debt, and we actually have a little bit of inversion right now. When you look at the 20-year Treasury, we can see that the interest rate is higher than that on the 30-year. So what is this signaling and why does it indicate a recession is around the corner when the yield curve inverts? Well, basically, the bond market is always trying to price in the future, especially the expected future of what the Federal Reserve will do. Everybody knows that the number one response from any central bank in dealing with a recession or a crash is to lower interest rates. So when you have the yield curve invert, where the shortest term interest rates are higher than the longest term interest rates, that means the market, the big money, the big players who are buying and selling bonds and moving the market here are expecting that a recession will occur at some point soon and the interest rates will have to be dropped as a result. And there is a higher likelihood of that occurring within 5 years than there is, let's say, in 2 years. The more time you give that, the more chances, the more odds, the higher risk you have of a recession hitting. And the market then starts to price in these short-term interest rates can move up because you want to be compensated for the inflation risk in the meantime, but if you hold it to 10 years, the Federal Reserve is very likely going to be dropping interest rates in between now and then, a lot more likely than them doing that in the next 6 months or 1 year. Now, the other thing that's going on here that's causing interest rates to move the way they are is a big buyer is pulling out of the market, a big buyer who's been primarily buying short-term debt, namely the Federal Reserve. As they pull out and as they signal interest rates are going up in the next 6 months to a year, you are having big money front run that, and you're also having the effects of this big buyer pull out. We know that the relationship between debt price and interest rates is inversely correlated. When the debt price goes down, interest rates go up. The debt price will go down when buyers, all else being equal, pull out of the market, and that means there's more sellers than buyers. That pushes the price down, that pushes interest rates on that debt higher. That's another thing that's going on right now is the Federal Reserve pulling out of being a buyer in the bond markets. As a result of this, growth-heavy sectors, especially like tech, have been taking a beating recently. You don't want to be in these high multiple companies in a rising interest rate environment. Money starts to flood out of these things that rely on the money printer, rely on the easy money, where they have super high valuations, and things like tech, a lot of tech stocks, a lot of NASDAQ stocks are down 80% or more from their highs within the last year. And so tech is dumping and big money like hedge funds moving into real assets, especially things like oil. So we're likely to see even more of this. And as the growth environment becomes harder and harder, money starts moving into real assets. Money starts moving into value, and you start to see things that are cash producers, income producers. You start to see things like real assets and energy, real estate, precious metals, commodities start to perform better and better. Now, in my opinion, it is only a matter of time before these rising interest rates cause such significant problems that a crash starts, a domino effect starts, and central banks have to step back in with more rescuing, more bailout, more stimulus. And I think it's very possible this starts in Europe with some of these European Eurozone banks who are so highly leveraged. This is a list from goldmoney.com. Alistair McLeod puts this out periodically. This is a list of Eurozone banks showing their leverage, their balance sheet size compared to their market cap. They're extremely highly geared. And keep in mind, these are globally systemically important banks. So these are the big players. And if something unexpected happens and they have unexpected losses on their balance sheets, it could wipe them out extremely easily. That could spark a domino effect to the rest of the global financial system. But even without something unexpected like that happening, it still is only a matter of time before the pressure on growth from rising interest rates that we're seeing right now slows down the economy so much that we have other problems pop up as well. Simply the nature of what happens when you've built an entire financial system that only survives on the back of an ever increasing money supply and ever lower interest rates. One of the many reasons why I think debt, especially government debt right now, is what Peter Schiff, I believe, likes to call return-free risk. Best case scenario, you lose 5 to 10% to inflation. Worst case scenario, there's default and you lose it all. Wouldn't touch it with a 10-foot pole. As always, really appreciate you guys. Thanks so much for watching. Have a great day.